equilibrium and discounting, okay, you can frame the ideas in which the market should react. It should be viewed as a discount across the board. And if it is in fact bullish, the banks will dogpile on this and send the price higher. And it should be with quick dynamic price action. Understanding where it should be reaching for, above old highs, above equal highs, okay, above closing a range, okay, which we don't really have in here. But I'm just showing you just in one example here. Already the first one, it's 300 pips. Okay. Then we have another price move all the way up here. There's no real retracements in here because watch, we have a high, equal, a little bit lower here, and then here's one here. If we would have measured the low to this high, it doesn't come down to 50%. It's nowhere near. I can eyeball that, and you can probably do that too. But I probably might. Let's just do it because I'm probably going to have some of you folks that are from different countries having a hard time understanding my English, let alone Forex. If we would have measured just this impulsive price swing right here, notice that even though we had the candle here lower on the fourth one, it had an up close, but it was still lower. Nothing came back down to equilibrium. It stayed at a high price, and it just kept going higher and higher and higher and higher and higher. So if we go back to adding the fib to that initial price low here, and we stretch it because now we broke this high, we're going to keep drawing the fib up on swings that move up dynamically. So we have this big parent price swing. So now we're going to wait until price gets back down to equilibrium. When do we start waiting for that? When the market shows a swing high, which it does here. Then we start counting to the fourth candle where it drops. So the fourth candle has to move lower or be lower than the highest candle that makes the swing high. It's a very simple thing. And then from there, we just start waiting and we count down every time it goes down to a newer low, low, lower, low, lower, low. And finally, what's it hit right here? Equilibrium. That's that 50% mark. As soon as it does that, the market is at a fair market value so that it can be bought on the banking level. It cannot be bought until it gets to that level or below. They won't come in, they won't do it. It's not based on Fibonacci. I'm just showing you in terms of equilibrium between old highs and old lows. It's just a valuation marker. That's all it is. Okay, so the algo will kick into a buy mode in here, especially if they have orders at that level or just a little bit below it. And if they are there, you'll know it because the price will react immediately like it does here. It hits it one time. It doesn't have another candle touch it. This one gets close to it, but it still rallies away. Okay, so now watch what happens. We have another impulse swing here. Price moves away from an area where we expect it to rally. Why do we expect it to rally there? Because between this low and this high, price should be sensitive here on the upside, and it rallies. Now watch what happens. This is a big, big step. I'm going to keep this Fibonacci just like it is. I'm going to add another one right on the low that starts here, and it runs up here. See that? So between this low up to this high, why are we counting this swing? Why are we using this Fibonacci price swing, Michael, and not something else? Because this one showed reaction to want to move away from an area we would expect it to move. And now watch, we have a swing high. Here's a high, lower high, and this candle is lower than the one on the highest portion of the swing high. So now we start counting down until price gets to what? Equilibrium or less. The next candle doesn't do it. This candle does. It goes right down through equilibrium down into what we call optimal trade entry. So when we get below equilibrium, all this time in here, look how much time it gives you opportunities to get in at 62 to 70.5%, which is the optimal trade entry sweet spot.